Hello and welcome to another video. Today's video we will be talking about the average stock market return and why that can be a misleading figure for new people that are new to investing, and why that can give a lot of false promises to unsuspecting people who are just blindly following, I guess, their favorite content creator or blog post or news article, Bloomberg News, or wherever they get their information from. You see, historically, the stock market has returned 10% per year on average, but that is the thing, it's on average. But when majority of people are watching videos about finances, majority of the content creators you hear talking about the stock market, they always mention that the average return is 10% per year for the stock market. And the problem with that is when you're watching a video, the average part just skims over our minds. So we heard average 10%. Now, to us, we're thinking, okay, maybe it's just a 1 or 2% swing up or down. But the reality is that is not the case. The swings can go high as 20% or as low as 20%. Meaning, if you were to invest, for example, your money in the start of the financial year, and then 1 year later, you decide to check your investment portfolio, and we just have some crazy events happening, you look and you see your investment portfolio has tanked by 20%. Now, you're going to be thinking to yourself, wait a minute, I was told that on average I get 10% return. Now, okay, I didn't get 10%, but I thought at least maybe 5 on the low end, but minus 20, what on earth? So you panic, because most people panic and then they sell, which means they're locking in the loss. Then they get out of the markets and they never ever invest again. But not only do they never ever invest again, they actively discourage other people from investing by claiming that investing in the stock market is a very dangerous thing to do and that it's a scam. Now, even that 10% average return isn't actually specifically true. As in, yes, it is true over a very long time, 100 years, you will average 10%. But the thing is, even if you do average 10%, that's not your take-home pay. The reason is because inflation, taxes, and platform fees. So that 10% is what's called a nominal return, which basically means it's what you see on the paper. It's before the real world kicks in. So you see that 10% and everybody touts that 10%, but they are touting that 10% as the nominal return. The real world return, which takes in facts the inflation for that current year, the platform fees, and how you invested it. If you invested it into an ISA or outside of an ISA where you are subject to tax. So the real returns are actually less, because if, for example, you got a 10% return, but inflation was 2% for that year, and with everything else, another 1% went. Well, your actual return was 7%, not 10%. Now, over the course of a very long time, the stock market has only ever once hit that actual 10%. Every other year, it's either more or it's less. Meaning, if you've invested, yes, you might have got a 15% return, or you might have on paper lost 15% because it's gone down. But the thing is, that's on paper. You don't actually lose money if you do not sell, because as the historical data shows, over the long period, so you should be investing for a minimum of 5 years. Now, ideally, the longer that you invest for, the higher your chance of making money. So if you see that your portfolio has decreased, then the worst thing that you could do is to sell, because if you sell, then you actually locked in the loss. But if you don't sell, then yes, on paper your investments have gone down for that year, but they will bounce back up, and it's a guarantee they will bounce back up, because in 120 years the stock market has averaged a return of 10%. And think about the amount of bullshit that this planet had to go through in those 120 years, from the Great Depression to World War One, World War Two, Vietnam War, Cold War, 9/11, all the outbreaks and pandemics, the Great Recession, and so many other crises, natural world events. Yet the stock market has always provided a return, meaning it doesn't matter, unless the world is going to blow up, which probably isn't going to happen. It doesn't matter. As long as you stay in the market, you will come out ahead, because history has shown it. Now, yes, history doesn't mean that the future will be the same, but let's be real, human nature doesn't change. And if for 120 years you've got a positive return, while we still are producing at a high rate, I don't really see how, barring some crazy alien invasion, the stock market won't give you positive results. So that 10% is an average rate of return. It doesn't mean that that's what you get year on year. Some year you will get more, some year you will get less. Some years will be choppy and some years will be brilliant. The main thing is hold tight, invest for the long term, and don't get emotional. So hopefully that was helpful. If it was, give it a like, comment what you thought below, subscribe, and take care.